Let's talk about credit history. There's a great wave of information now on the internet regarding credit scores. It's a little known fact that the VA actually does not set a minimum credit score requirement. Lenders do that. Lenders set in place minimum credit scores for the loans that they feel they can comfortably sell as soon as they've originated and funded them out of their own money. So a typical minimum credit score these days is 580, which would get the veteran a loan amount up to $417,000. Typically, to be eligible for a loan amount in the high-cost areas, such as we mentioned Hawaii, and go above $417,000, your credit score would have to be over 640. Now, lenders will pull credit from 3 different bureaus that are not related to each other in any way at all: Experian, Equifax, and TransUnion. And the veteran must have at least 1 credit score, and preferably 2 or 3 scores, on that tri-merged combined report. The lender will perform what's called a CAVERS inquiry on all veteran borrowers, which has to do with whether or not the veteran owes money to the federal government anyway at all. Typically, a rent or a mortgage history is required. There are occasions where if the veteran is a first-time homebuyer and doesn't have a rent history, that we can use what's called a budget letter, asking the veteran to explain how they will budget themselves to take on the new housing payment, seeing they have no history of making a rent payment. That is possible. Now, in a scenario where there is no credit history available, for example, a veteran that's just not got any credit cards or auto loans or student loans or past house payment, doesn't have anything on his or her credit report, we would use what's called alternative credit history by means of looking at utility bills or a utility reference letter from, gas, water, cable, electric, so on and so forth, auto insurance, anything that's paid on a monthly basis, typically not a revolving account, but an installment account where the payment's the same every month, a cell phone bill. Those things can be used in place of and in the absence of credit card payment history and auto loan payment history and so on and so forth. Now remember that in the event a veteran's getting a loan and their spouse is not signing on the loan, they're considered a non-purchasing spouse. That spouse's bad credit, if he or she has bad credit, is not going to be a reflection on the veteran or the veteran's ability to qualify. What does happen is that spouse's monthly debt obligations must be counted against the veteran. And for that reason, a credit report is required even on the spouse if that spouse is not borrowing or not signing on the loan, is a non-purchasing spouse. Collections on the credit report may not necessarily be required to be paid. It's really up to the underwriter's discretion. A lot of times the underwriter will lean on the automated feedback from the computer engine that we talked about to decide if a collection has to be paid or not. Upon review and explanation from the veteran as to what happened and maybe some supporting documents as to what happened, the underwriter can make that judgment call to leave that collection unpaid and untouched. And of course, that is on a case-by-case basis. As we're talking about credit history, a lot of times there's a judgment that's involved. Judgments must be paid in full. Or if there's a payment history that the veteran's already negotiated with the creditor, the lender's underwriter is going to want to see proof of that payment history for at least a 12-month period. Very important. The same with consumer credit counseling or any other form of debt management program where the veteran at some point or another was not able to manage his or her debts by themselves and so brought in a third-party agency such as CCCS, debt management program, to handle the payments to the creditors. In those situations, we would want to see a 12-month perfect payment history. We talked about bankruptcy earlier. Foreclosure or deed in lieu. If the veteran lost a home in foreclosure over 2 years ago, then he or she is eligible, of course, with reestablished credit. In those instances, our underwriters are going to want to see a solid rent history. If the veteran had a failure in their housing payment history recently, as recent as 2 years ago, then their most recent housing payment history, their rent history, becomes even more critical in making that underwriter feel warm and fuzzy about approving the VA loan. Let's talk about debts and obligations for the veteran. The veteran must verify any alimony and child support that he or she is paying. If they have a student loan that's scheduled to begin within the next 12 months of the time of closing on the home, debt must be counted. Now, it's very common these days for the veteran to be able to defer the student loan for beyond 12 months from the date of closing, and that's okay. If that were to happen with proof from the student loan company, the underwriter would exclude that monthly obligation from the debt-to-income calculation. Any loans that are secured by money belonging to the veteran, for example, a loan that's secured by their retirement account, a 401k or an IRA, those payments have to be counted. counted in the debt-to-income calculation. Now, when calculating the estimated housing expense, maintenance, utilities, so on and so forth, as we said earlier, in the residual income calculation of the loan, we use 0.14 per square foot of the size of the home. Now, installment debts that have less than 10 months remaining don't necessarily have to be included. So if the veteran's got a car payment that's about to be paid off in 7 months, for example, oftentimes the underwriter will feel comfortable disregarding that payment. If there's been a history of consistent late payments on that account, it might be more difficult to get the underwriter to sign off on that. Let's talk about income and employment. Of course, the standard underwriting rules apply on a VA loan. We're going to want to see a 2-year work history. Anything that's less than 2 years is considered case by case. Someone that recently graduated with a diploma or certification in a particular profession and just got into that field. For example, a nurse that just got his or her certification and just entered the workforce, that's okay. That person's not always going to have a 2-year history. By and large, we want to see a 2-year history of W-2s and tax returns. Any overtime income and second job income generally needs to have a 2-year history. So what happens in those cases, if you, the veteran, are needing overtime income to help you qualify, we're going to want to get a direct employment verification from your employer, breaking down your base salary or your hourly pay and breaking down the overtime income to make sure that the underwriter is comfortable with the stability and the probability that that overtime will continue. That's not to say that if you have worked overtime for less than 2 years, that your loan will not be approved or that the overtime will be disregarded. That is considered on a case-by-case basis. Commission income or bonus income, self-employment income, same thing. Those that file what's called a Schedule C on the tax returns. We're always going to want a 2-year history of that unless the veteran was involved in that same field prior to the related employment. We're always going to want to see a 2-year history of that. There are exceptions, as you can see on there. If there was previous related employment in that field or special training, then exceptions can be made. Now, self-employment income is usually averaged over the most recent 2 years, 24 months. Alimony and child support must be verified and considered to be stable. So we're going to want to see 6 to 12 months of stubs showing the child support income. It's a lot easier to deal with if it's coming directly from DES. But that income does have to be verified and considered stable. A lot of folks have seasonal jobs, teachers, folks that are working out in the field, picking fruit, for example. I've seen that very often. So they pick fruit a certain number of months in the year, and the rest of the time they're on unemployment. That's okay. If there's a pattern of that, if we can verify a history of that type of employment, we will actually use not only the W-2 income, but the unemployment income, and the underwriter will make the judgment call that that unemployment income will continue. Now, any other kind of income, such as pension, retirement, disability, has to be verified. We're going to want to see an award letter from the source, as well as proof of the last couple of months through bank statements showing the amount being deposited into the bank account. Now let's talk about residual income guidelines. As we said earlier, depending on what region of the country the veteran's buying, the residual income amounts vary. They also vary based on the family size of the veteran. So let's take an example here. In the South region, for loan amounts of $80,000 or more, if a veteran and his wife, for example, and one child are considered the family, if you look at the column that says a family size of 3, if you follow that row of 3 all the way to the right for the South region, you'll see that the required amount is $889. What does that mean? What that means is the veteran has to have leftover income of at least $889 once the federal and state taxes, Medicare, Social Security, any other deductions on the paycheck stub, their monthly debt, child care expenses, the proposed or anticipated maintenance and utilities, all of that's taken out of the gross monthly amount, and there must be at least $889 left over per month. And that's how the residual income chart works. And this is updated every so often. This, what you're looking at there on the screen, is the most recent for the year 2011. It actually was the same for the year 2010 as well. Now, let's talk about compensating factors. A lot of times a VA loan will hang in the balance, and the underwriter will reach out to find reasons to approve that veteran's loan rather than decline it. Compensating factors are extremely important in cases where the veteran has sketchy or plain outright bad past credit history, has had a recent foreclosure or bankruptcy, or just doesn't have any history, or doesn't have a rent history, or has a major payment shock coming between what they're paying for rent and what they're taking on. In those instances, the underwriter is going to reach out for what we call compensating factors. And here are some of the compensating factors that are common. Of course, an excellent credit history would often compensate for a high debt ratio or a low residual income. Conservative use of consumer credit. You know, a veteran that's got $10,000 in credit card limit and has run it up to $9,995 is not considered a conservative user of credit. But that same veteran, if he's got $10,000 available in credit, has only got a balance of $1,000, well, that says that veteran is a diligent or responsible or conservative user of credit. Minimal consumer debt is a good thing. Long-term employment, someone that's been on the job a while, is likely to get a thumbs up from the underwriter despite other factors being weak. Now, sometimes a veteran is able to get a 100% loan even with lots and lots of money in the bank. You know, if there's significant liquid assets, that's a great compensating factor to offset other problems such as credit issues in the past or a high debt ratio, so on and so forth. A veteran putting money down or even a large down payment can be a compensating factor. A veteran that's going from a rent payment to a house payment without much increase in the dollar amount per month, we call that payment shock or lack of payment shock. That's considered a compensating factor. Of course, a veteran that's way over the minimum residual income amount is going to be considered someone that's having a compensating factor. And again, a low debt to income ratio is also considered a compensating factor. Compensating factors are very important in situations where there are other features of the file that are problematic. And so when that happens, rather than turn the loan down, an underwriter can turn to these facts in presenting a case and making himself or herself feel comfortable about okaying that loan and releasing a VA guarantee on it. Now, here's how the process works for a VA loan. The very first thing that happens is, of course, the loan is originated with a VA-approved lender. All the VA applicable forms are completed. There's disclosures completed. Once that's done, or during that time when it's being done, your lender ought to be ordering your certificate of eligibility to make sure that your entitlement is intact, as well as the CAVers to make sure that there aren't any problems with the federal government that are hidden. A lot of veterans don't know they might owe money to the federal government for something that might have happened a long time ago. Those things have to be investigated and cleared before the process can continue because, of course, a VA loan is a federal government-backed loan. The next step would be to verify the VA benefits if applicable. The underwriter will then run that file on the automated VA loan engine online, and usually within 60 seconds, he or she would get a feedback, and that feedback is going to be, favorable or not favorable. In the event that it's favorable, the process can now go full force ahead and becomes more of a verification and a substantiation more than an underwrite. Okay, so when an automated approval is being issued online, the underwriter is now basically substantiating and proving that what was input into the system was accurate and complete. If the feedback was not favorable in automated underwriting, the underwriter is now going to go looking for compensating factors to make that loan go through. A VA appraisal is ordered, a termite report is ordered, the loan is processed, processor at the lender will check for all the right forms. Of course, that's completely done and then submitted to the underwriter for final signatures. The approval is issued, and then from there, you can close. And this whole process typically takes anywhere from 21 to 30 days. It really shouldn't take more than 30 days. Back in the day, VA loans had a stigma about them that they used to take forever. That's really not the case anymore, at least with a direct lender. If you get a VA loan through a direct lender, you really ought to be closing in 30 days or less. I've been blessed to be a part of many VA loans that from beginning to end took, less than 3 weeks to close. A staggering pace because a lot of things are done online now and done through the internet. A couple of very important links for home buyers is there's a wealth of information and resources, not just on VA loans, but home buying in general. Contact your loan professional today to get your VA loan application started. Thanks for watching, folks. For all those veterans who've watched this webinar, we're so thankful for your service to the country and for the freedom that you've brought, or I should say the freedom that you've preserved. And that makes us that much more motivated to make sure that your VA loan goes through. And I'll be honest with you, I myself have a real soft spot for veterans in terms of financing, and we tend to go the extra mile to make sure those loans are done, and we jump through the hoops that need to be jumped through to make sure that VA loan does not crash and burn, and make sure that veteran who deserves everything our country can give him is able to get his or her keys to a home.